United States, 2024, the world's largest auto industry is facing a full-blown crisis as new trade policies and energy instability simultaneously impact the manufacturing ecosystem. The imposition of a 25% import tax on cars from Mexico and Canada, along with the possibility of a disruption in Canadian oil supplies, is creating an unprecedented double shock to the U.S. economy. 25% tariffs, a direct hit to the auto production chain. In 2024, the U.S. imported 7.38 million cars, mostly from Mexico and Canada, two important trading partners in the auto manufacturing industry. The U.S. government's new policy, which is expected to impose a 25% tax on all types of cars imported from the two neighboring countries, is causing deep concern throughout. In particular, General Motors, GM, one of the three big guys of the U.S. auto industry, is the most heavily affected enterprise. According to internal data, more than one-third of GM vehicles sold in the U.S. are produced in Mexico and Canada. This means that if tariffs are imposed, production costs will skyrocket, leading to higher vehicle prices, lower profits, and a serious decline in GM bracing for the future, short-term solutions and long-term vision. In a recent statement, GM CEO Mary Barra said the company will implement a short-term response plan, in increasing production at domestic plants, maintaining fixed raw material prices. However, the reality is that current U.S. plants do not have the capacity to replace what is being produced in Mexico and Canada. Expanding domestic production also requires time and large capital investment. In the long term, GM has committed to investing $59 billion to expand and upgrade its U.S. plants. However, this is a long-term strategy and cannot produce immediate results. During the transition period, GM will face many challenges in terms of supply chain, labor costs, and the ability to maintain market. Mexico, GM's irreplaceable manufacturing center. Mexico is currently a strategic manufacturing center for GM with 4 large factories, producing more than 700,000 vehicles per year. Notably, in 2024, GM took the lead in electric vehicle production in Mexico, with 99,529 electric vehicles, accounting for 60% of the country's EV. It is almost impossible to completely withdraw production from Mexico in the short term. The production infrastructure is complete and cost-optimized. The supply chain of raw materials and labor as well as relocation will cause serious disruptions and increase financial burdens. Shadow 2, Canada could tighten oil exports. While the auto industry is grappling with tariffs, another variable is worrying the U.S. market: Canadian crude oil supplies. Currently, more than 4.3 million barrels of oil flow from Canada into the U.S. every day, accounting for 60% of the country's total oil imports. In particular, heavy crude from Canada is a feedstock that is specifically designed for the refineries in states like Michigan, Ohio, and Pennsylvania. Texas oil, while readily available, cannot be substituted due to its different chemical composition. If Canada were to reassess or tighten its oil exports, even a small disruption could double the price of gasoline in the U.S. This would directly impact consumers, higher travel and living costs. Transportation and logistics industry: higher operating costs, rising commodity. The economy in general, are easing inflation, falling consumption, slowing growth. Dual crisis, requiring stable policy and long-term. The combination of unstable tariff policies and the risk of disruption of essential energy sources is causing many experts to warn of a dual crisis that threatens the entire U.S. manufacturing. Although the U.S. government and corporations such as GM have declared the goal of building a sustainably domestic production, without policy, financial support and a reasonable transition period, this goal is unlikely to become a reality in the near future. Without flexible adjustments in trade and energy policies, large enterprises such as GM will gradually lose their competitive position, while consumers will suffer the consequences with high car and gasoline